Welcome to the Dutch Investors Podcast. In today's conversation, we're joined by Adam Seessel, former investigative journalist turned successful Wall Street fund manager and author of Where the Money Is: Value Investing in the Digital Age. We dive deep into how value investing has evolved from Benjamin Graham to Buffett into the tech-driven 3.0 era. Adam shares his hard-earned insights, practical frameworks like his BMP checklist, his mistakes, and we talk about what a potential value investing 4.0 looks like. Links to his socials and books are in the episode description. Enjoy today's conversation with Adam Seessel. How are you doing, Adam? Nice to meet you.
Always hate.
How are you doing, Adam? You speak a little bit of Dutch.
5 words, 6 words.
5 words? Well, we'll make it 7 after this podcast.
All right, sounds good.
Are you from New York? Is that right?
Well, I'm from across the river in New Jersey, but close enough.
Close enough. And how's life in New Jersey?
All is good. I mean, I'm in New York City, but I was born and raised in New Jersey. So,
I see.
Yeah, everything's good. We had a really big heat wave, which you may have heard about. So
yeah, definitely.
It was maybe 39 degrees centigrade here for several days. So it was really, really hot. But now everything's cool again. But and then the New York City voters just, voted for a Democratic Socialist. I'm sure you saw that. So.
Yeah, you can't escape the news, right?
We need to get the Europeans over here to tell us about their experience with socialism.
We'll ask the French.
Well, and the English and the Germans, right?
Well, Adam, I'm glad you took out the time to come on in your busy schedule. Thank you so much for that.
You're welcome. I'm happy to do it.
So, if I did my background check correctly, you were an investigative journalist before becoming a fund manager?
And by the way, we're reporting now, yeah?
Absolutely, yeah.
Okay, very good. Yes, I was an investigative reporter in my 20s. It was a lot of fun. Got a lot of people in trouble, righted wrongs, won national prizes. But when I was getting ready to be 30, I said, the money is terrible, the hours are terrible. Let me see how I can use my research skills to make more money. We were getting ready to have a child. This was just about 30 years ago. So I had friends who'd gone on to Wall Street after college when I went into journalism, and they said, Adam, being a journalist and being a researcher on Wall Street are very much the same skill set. It's just, you have to learn accounting and, you have to read financial statements. And the goal is quite different, right? In journalism, you're trying to tell the truth and right wrongs, but in money management, you're not trying to right wrongs, but you are trying to arrive at the truth. So very similar skill sets. And I was shocked at how transferable the skills have been over the years. We can talk more about it. But for now, suffice it to say that Warren Buffett has said if he couldn't be an investor, he would be a journalist because it's fun and it's interesting. And the skill sets of researching and reading and talking to people are almost identical.
So are those the things that translated most to becoming a analyst on Wall Street, a fund manager now?
What's really interesting, Seem, is when you do investigative reporting, there's some reporters broadly speaking fall into two camps. One is the folks who only do document-based reporting. So they'll go deep into the documents, government documents, and they'll do a deep dive into an issue. And when they emerge after having read all these documents, they have a very deep understanding of the issue, but it's a very academic understanding because they haven't talked to people. So they understand the issue from a paper perspective, but not from necessarily a human perspective. Then on the other side of the spectrum, and I'm speaking in generalities, but it's instructive. On the other side of the spectrum, you have people who all they do is talk to human sources. And so it's interesting, they talk to the mayor and they talk to the city council people and they talk to people in the street, but it's very superficial because they haven't really taken the time to do a deep dive on the issue. So it's like one side has a dry but deep understanding of the issue, and the other side has a very superficial understanding of the issue, but they have the human part. So the human people are like the gossip columnists, and the dry people are like the academics sitting in some university. But if you combine the two, if you combine documents with human beings, you're really cooking. So, and that's equally true in journalism and investing. So, when I would do my investigative reporting, I would start with a deep dive into the documents, but then I would interview human beings to get the context of what I had learned. Because I was prepared, they would give me good answers and they would lead me to other human sources. They would also direct me to document based sources. So I would read more, I would talk to more people. My understanding, both on the human level and on the academic level, would deepen. Then I would talk to more people and so on until you were really cooking. And so, I would go to my interviews. This was back before PCs, but I would go to my interviews with thick stacks of documents like this, and I would show them. Like I would put it down on the table like that so that they knew that I had come prepared. And so they were forced in some ways to give me honest answers and better answers because they knew I would catch them if they didn't. And so, as you can see, I now do the same thing, but, here's Amazon, here's Flutter, both of these stocks I own. Here's Dollar General, which I own, Flagstar, which I don't own. So like that. So the synthesis of document-based research and human-based research is really, really, really important in both disciplines. And so I'm essentially a reporter now, Seem. I'm just a reporter trying to make money as opposed to trying to tell the truth for the general public.
Fair enough. Is that how you prefer doing your research, on paper, or how do you do it?
Both are necessary, but neither is sufficient. So here again, if all I did was read the 10Ks, like I wouldn't understand like Flutter. I wouldn't understand how Flutter operates in the marketplace, right? It's sports betting, right? If all I read was Amazon's 10K, I wouldn't really understand how it goes to market in e-commerce or cloud. I have to talk to human beings to understand that.
Absolutely.
Now, conversely, if I didn't read the financials and just talk to human beings about, do you like Amazon and why? Do you like FanDuel, which is the sports betting site that Flutter owns here in the United States? They would give me interesting answers, but I wouldn't have any context. I wouldn't know their financials. I wouldn't know how much money they make. I wouldn't know their return on capital. I wouldn't know their profit margins. So I would have no context. So the one is surface and the other is depth. But you have to have both, and that's where the synthesis, that's where the magic happens when you're doing documents and human sources.
Yeah, so both hard and soft stuff is
Yes.
important. Yeah,
That's a good way of putting it.
So I have the book right behind me, Value Investing.
Great.
I don't know if you can see it, but
I see it in the distance. Yep. Good. It has not yet been translated into Dutch, but thankfully everyone in Holland speaks almost flawless English. So,
well, I appreciate it. If I'm at a benchmark, I appreciate the compliment. But anyway,
it is a compliment.
It's actually it's not one of the first books I read, but it was one of the first books that actually made things click for me.
Good.
Where you talked about most of my knowledge and what I was looking for was pretty surface level. Book basically taught me.
You mean from your own experience?
Yeah, for my own experience, yeah. And the book basically taught me that sometimes you need to take a step back, play around with some of the figures, with some of the numbers, talk to people, have a checklist. And it was one of the first books that taught me some useful new insights back then. And I just wanted to say thank you for that, because it was very influential looking back now.
Great. Well, I'm so glad it helped, Seem.
So what was the spark for you to write a book? I mean, You have been pretty successful with being a fund manager, a journalist, analyst on Wall Street, and now an author. So why did you decide to write a book?
Well, it was in one word, it was COVID. COVID hit, and all of a sudden I couldn't go visit my companies, right? I'm a reporter, so I go out and visit companies and people and interview people and see what's going on out there, not just in New York, but in the bigger parts of the United States. So I couldn't do that. And so, I had a literary agent tell me, you should write a book, because I'd been writing some for Barron's and Fortune, been getting back into my first career, but writing financial stuff. She said, you should write a book. I said, I don't have time to write a book. And then COVID came along, and I did have time to write a book. I was sitting there, in lockdown like everybody else. And so I thought, she's right. It's a very good time to codify my thinking and to, I did it as much for myself as I did for others, because I had all these thoughts running around in my head about, you know, old value investing and the way Ben Graham and Warren Buffett used to do it. And then, you know, the rise of tech in the digital age, and how value investing and tech just did not get along at all. They just didn't, they were like oil and water. So I thought, well, it's time to you know, codify and synthesize my own thinking on this and put it down on paper. And I'm very glad I did, because it helped me a lot. And then, it's helped people like you. So it was a win-win, as we say in the States.
Well, let's get into that because, I have tons of questions to you about the book. It's called Value Investing in the Digital Age. You describe the evolution from Benjamin Graham, which you call Value 1.0, to Buffett, and later on to what you call Value 3.0.
Yeah,
How did you come up with it? Can you walk us through that?
sure. Well, actually, the full title of the book, Seam, is Where the Money Is. And then the subtitle is Value Investing in the Digital Age. Where the money is a famous quote when they caught a bank robber in America 100 years ago named Willie Sutton. And they said, why did you rob so many banks, Willie? And he said, well, that's easy. That's where the money is. So he was a little bit of a wisecracker. But
It's pretty funny.
anyway, it was a good line, and I used it because tech is where the money is now, right? Why do I study tech? It's not because I love tech. I don't like tech. I resist most technological innovations. I'm not a leading edge early adopter tech guy. I study tech because it's where the money is, for the same reason that Willie Sutton robbed banks. So, and that kind of dovetails with your question, Seam, in the sense that value investing, which when I went onto Wall Street 30 years ago, I was steeped in and learned at a very good firm called Sanford Bernstein. I am a value investor. And so I started to think that there were several different phases of value investing. Although I have to say that the value 1.0, value 2.0, and value 3.0 didn't come from me. It came from my friend Chris Begg at East Coast Capital Management. Like a good journalist, I have to, give attribution to my sources. So that's not my invention, value 1.0, 2.0, 3.0, but it's really Chris Begg's. But anyway, value 1.0 is 110 years ago, Ben Graham, this brilliant guy who graduated at the top of his class in Columbia and was going to be, I think he was offered 3 different positions at Columbia University after he graduated, in philosophy, math, and economics, or something like that. They wanted him to teach in 3 different departments. That's how intelligent he was. But his father had died, and he needed to make a living for his family, so he went on to Wall Street, because that's where the money was, because he had to make a living. And the Wall Street that he saw 110 years ago was really like a casino. One of his early jobs was keeping the books for the presidential election 1916. You could walk into a New York Stock Exchange listed firm and legally place a bet on who would win the election in 1916 for the president of the United States. Now, we're getting there again now with crypto and stuff, but you still can't bet on who would win the president on Wall Street today. But back then you could. It was a crazy, wide open, Wild West casino type place. And he found this all very interesting, Ben Graham did, but he said, I got to make money. I can't just roll the dice, and I got to find a systematic way to make money. So he came up with, what we now know is the foundation of value investing, which was essentially an attempt to systematize and codify and regulate a set of rules so that when you made an investment, you weren't just guessing. You weren't just playing a hunch. You weren't playing the market. Even today, people say, I don't like Wall Street. I don't like playing the market. And I say, I don't like playing the market either, because I'm a value investor and I have a system to attempt to beat the market. So Ben Graham is the father of value investing. Now, his school of value investing turned out to be very conservative. So he didn't care how much a company made. He didn't care what a company did, what kind of businesses it was in, if it was a good business or a bad business. All he cared about was the company's assets. It was a very static, very conservative way of looking at it. He would take a company's balance sheet and he would add up what they owned, their cash and their inventory and their factories, and then he would deduct what they owed, their accounts payable, their debt to the banks, and so forth. And he would come up with a number. And if the stock were trading below that number, he would buy it. It was genius at the time. It sounds commonsensical to us now, but back then, as I said, it was a casino. So to have rules and so forth to proceed to build wealth was revolutionary at the time. So that's value 1.0. Now, it turns out that was a very good system for, the early part of the 20th century, because there was a lot of scams. There was a lot of, the markets weren't very well regulated. And then, of course, we had the Depression in the 20s and 30s, and a lot of companies were trading below their net asset value. So you could very profitably buy a lot of different companies on the American Stock Exchange that were trading below their liquidation value. He was a very conservative investor in the sense that he didn't care what the company did. He didn't care if the business grew. He just wanted to know, was this company worth more dead than alive? So if a company had $100 worth of assets and $50 worth of liabilities, theoretically, you could liquidate that company tomorrow for $50 a share, right? $100 of assets, you sell the assets, you take $50 of those assets, of that cash, and you pay off the liabilities, and you're left with $50 for the shareholders. So if he could buy it at $30 or $35 a share, he was ecstatic, because it was selling below its liquidation value. And he had other metrics that were a little more sophisticated, but that's the basic idea. So that was value 1.0. And that was what his star pupil, class of 1950 or 1951, Columbia Business School, when Ben Graham was getting up in years, his star pupil was Warren Buffett at Columbia Business School. Only guy that ever got an A+ from Ben Graham. So Buffett learned value 1.0, and he worshipped Ben Graham as a hero. He worships him now to this day. He's 94 years old. But Buffett, as time went on, understood that the world had changed after Ben Graham, that, companies were interesting not so much for their liquidation value. They were interesting because they could make money, and they could make money over a long period of time. So Buffett began in the 50s and 60s to study things like television broadcasters, which, there were only 3 national broadcasters in the 50s, which was sort of a license to print money. He would study Walt Disney, which had the theme parks and the movies. He started to see that these companies were worth a lot more alive than dead, and that looking at them with recourse only to asset value was a short-sighted, and his partner Charlie Munger would say foolish, way to value a company. The value of a company, as Buffett said, was, its future cash flows discounted back to the present. So if you had a company that had a long and prosperous future, like a television broadcaster or like a consumer products company or Disney, that company was worth a lot of money. Now, you can't predict the future. Nothing is given or inevitable. But, back in the 50s and 60s, it was a fair bet to say that television broadcasters and consumer products companies and, content companies like Disney had a long and prosperous future ahead of them. So that was value 2.0. Basically, paying a higher price, not as conservative a valuation framework as value 1.0, but gravitating toward better businesses and focusing not on the asset liquidation value, but on the long duration of cash flow that was likely to accrue from these businesses. So that was value 2.0 with Buffett. And he increasingly adopted this strategy with enormous success. We all know his success. He's one of the richest person in the world just because by dint of investing. But I thought that the world had changed enough in the early 21st century that we needed a value 3.0, because I thought that Buffett was missing a few important things. So he was missing, one, that the digital age was upon us and is upon us. Two, digital companies act in radically different ways, both consumer facing and also their unit economics are radically different and radically better than even his best companies. Coca-Cola was another of his great investments. But even Coke has ingredients, right? They have sugar, they have water, and they have to make this bottle or this can. They have to have a whole bottling infrastructure to put the sugar water in the can. They have to have trucks to get it around to people. They have to have vending machines to keep it cold. Google, Facebook, Microsoft, they don't have any of that stuff. Their product has no cost of goods. It's zeros and ones. It's almost a costless thing. And then, if you thought Coca-Cola had a dominant market share, Coca-Cola has nowhere near as dominant a market share as Google in search or Facebook in social media or Microsoft in office productivity tools. Go down the list, right? Adobe and creative tools. So the list goes on and on. So these are much better companies operating in radically different ways. And Buffett really never got digital companies. Part of the reason he never got them is they were very ambitious in investing for the future. So when Buffett came of age in value 2.0 world, he wanted all the cash. Coca-Cola, he wanted Coca-Cola to give them shareholders back all the cash, because otherwise they would do stupid stuff like it with it. Like, he remembered when Coca-Cola tried to buy a movie studio. Like, what business does Coke have buying a movie studio? Like, what synergy is in that business?
Well,
None.
I can see one.
Product placement?
Yeah, selling Coke during the
No,
movie.
you can pay for that. You pay for that. You don't have to buy the whole business. You just pay for that.
Yeah,
You
I
don't have
know.
to buy the whole thing. That's way too far, way too much.
I see, yeah.
So he learned that companies could do a lot of harm by buying stuff with their excess cash. But like Amazon and Facebook and Google and these kind of companies, they add tremendous value by reinvesting in new technology. So you see that with Amazon and cloud, right? They essentially invented an industry. And now you see that with artificial intelligence. They're spending billions to build out their artificial intelligence capabilities. So it's a different world than Buffett inhabited in the latter part of the 20th century. Early part of the 21st century is materially different enough to where I thought we needed to have what my friend Chris Begg calls a value 3.0 framework for investing.
Pretty crazy, right? That Benjamin Graham realized Buffett's excellence so early on, giving him the only A+ he's ever given. And seeing what Buffett turned out to be now is such a cool story if you think about it.
I mean, yeah, to Graham, it was pretty obvious to Graham that he was a prodigy. I mean, and like all prodigies, he had talent. He was incredibly numerate, and also he was incredibly curious about the world, which is why he wanted to be a journalist, right? If he couldn't be an investor. So yeah, he could do the research, he could talk to people, and then he worked like hell. Like he talks about how, when other young men were at home looking at Playboy magazine, he was reading, the Moody's stock manual. He was
Just as exciting, right?
for him. Yeah. Not for most people, but for him.
I see what you're saying. Yeah. In the Value 2.0 chapter, you wrote, and I'm quoting the book here: Value 2.0 companies were capturing where the money was, not where the money is. I really like that. But that does bring me to a question regarding AI, which you just mentioned. It kind of looks like we're heading towards this new time, this new era, with Google search for the first time declining, changing more to large language models. We have self-driving cars, we have the cloud, perhaps even AGI eventually. Are we going, or are we heading to a value 4.0 moment with AI? What's your view here?
Well, I conclude the book by saying at some point we will need value 4.0. I mean, I'd be foolish to not say that. Like, we've evolved twice in 100 years, but that's the end. Like, that's, you know, that wouldn't be a very supple mind on my part. So we definitely will need value 4.0 at some point. When we get there, hard to say. Right now, I think AI is an extension of the digital age. It's an extension of value 3.0. There's so much hyperbole and so much hype about AI. People forget that it's been around for 15, 20 years already. I mean, it's not like 2 or 3 years ago when Microsoft invested in OpenAI. It's not like they discovered artificial intelligence. It's an evolution. So I personally don't believe that it's bigger than fire, for example. I don't believe that. And so people ask me, Seem, whether I have an AI strategy, and I say, basically, my AI strategy is to continue to invest in the mega cap tech companies because they're the ones who have the resources to exploit AI and commercialize AI at scale. So, and when I say resources, I mean two things. I mean financial resources, money, and then engineering talent. So, like, there's a reason OpenAI, what's OpenAI's valuation? 300 billion, something like that?
Yeah, close to it.
Something like that. What's Microsoft's valuation?
3 trillion?
Right. So OpenAI's valuation is a tenth of Microsoft's. And who gave OpenAI that valuation? Microsoft, right? They invested. So if AI is so huge, why would OpenAI take Microsoft's money at a tenth of the market cap of Microsoft? So there's only two answers. It's a rhetorical question, but really you can answer it. There's only two answers. One, they're stupid and they left a lot of money on the table by selling out at 300 billion, whereas really they're worth 10 trillion, right? Why would they sell for a $300 billion valuation if they're worth more than Microsoft, right? Doesn't make any sense. But the other answer, which I think is the correct answer, is they need Microsoft. They need Microsoft's cash and they need Microsoft's resources to get to the next level. So I feel very comfortable investing in the mega cap guys who are investing in the next level down, in the OpenAIs and the Anthropics, in the Perplexities. These guys, these next level companies need the big guys to realize their dreams. So now, look, with Alphabet and search, you raise a good point. And, I own a lot of Alphabet and I'm thinking hard about whether AI is going to disrupt search. I would be foolish not to entertain that as a possibility. I see my own habits, I see my colleagues' habits changing. So this is part of interviewing human beings, right? Being in the real world and knowing what's going on. So I'd be foolish not to say that it's plausible that search's best days are behind them and they're going to go the way of Coca-Cola, for example, where per capita consumption of Coca-Cola has been going down in the United States for 30, 40 years, something like that. People just, it's a mature business, Coke. So sure, could Google search go that way? Yes. And I'm thinking about it. I'm reading about it. I'm talking to people. I'm doing my research, right? Reading documents, talking to people, reading documents, talking to people. And, unfortunately, or fortunately, I mean, the reason my job is interesting is it's never clear. It's never easy because, on the plus side, Google has a lot of distribution, right? They got a lot of eyeballs and they have a lot of money and a lot of engineering talent to throw at their own AI effort. And so sometimes I think that people are making the classic error of thinking that it's a static pie, right? That here's the pie of search and Google has 90% of it. So there's this little sliver that they don't have. And if we just redefine search as, queries, including AI, the bear case against Google is that the 10% is going to go to 20 and 30 and Google will wither. But what people forget in that analysis is that the pie is growing, that queries are growing. So you could posit a scenario where Google loses 15 points of search and is still bigger than it is today because the explosion of demand for knowledge is so huge. So these are the things that I'm exploring, and this is what makes my job, depending on the day, exciting or maddening.
Yeah, absolutely. My question was more pointed towards I see what you're saying, right? And I agree. If you could have seen this shift from 1.0 to 2.0 or from 2.0 to 3.0, you could have spotted this shift and profited from it. In the Netherlands, we have a saying: afterwards, you look a cow in the ass. It just means that everything becomes clear in hindsight. So, so do you think that what you did, laying out the value 1.0 to 3, the frameworks, can it only be done in hindsight, or are there signs or ways that investors can potentially spot the next 4.0? And what's that going to look like if it's not AI?
Well, it's a fair question. Of course, you can spot it. And the way to spot it is the economics become different. So, Coke, great business, high profit margins, branded, big market share, economies of scale, right? Global distribution, but still has, ingredients, right? Still has sugar and water, still has aluminum, still has a bottling network. Contrast that with the software companies, which we already did, right? No cost of goods, no physical presence to speak of, right? Winner take all dynamics, right? When someone standardizes on social media, everybody standardizes on social media, right? Facebook. So radically different economics. So that's what you're going to look for with value 4.0. So far, artificial intelligence is just digital economics. In fact, it's probably worse economics than the software companies because it's highly expensive to train these models, and it's highly expensive to get the answers, get the inferences back from all the questions. So that's number one. That's the first knock against investing in an AI company. It's unclear whether they can make money. Second, no one's standardized on an AI company yet, right? It's now who's going to win, ChatGPT or Gemini or Perplexity or Anthropic, right? It's a bit of a gold rush to see who's going to win. But nothing I can see, Seem, in my analysis of artificial intelligence tells me that this is radically new economics that's going to necessitate an entirely new framework. It's an evolution or an iteration of the digital businesses that I'm familiar.
I see. Yeah, that
I could be
makes
wrong,
sense.
and I'm happy to change my mind, but that's where I am now.
Yeah. So another part of the book that really helps me, it still helps me today, but especially looking back, was the BMP checklist, Business Management Price Checklist. Can you take us through it, and how did you come up with it?
Well, look, I mean, I came up with it as a way of dealing with my own frustration, which you have probably felt, and any investor who has felt in trying to, you know, go into the stock market and say, well, what the heck do I buy? Like, how do I do this? It's like a forest out there, you know? So you need a compass, you need a map, you need a set of tools to navigate. So, Graham had his liquidation analysis. I have my, as you say, BMP checklist. So B for business, M for management, and P for price. So it's just a way to say, okay, this is really confusing. There are a lot of businesses out there. Let me just sort of systematically go through each one and say, well, is this a good business, right? Is it a good business? And, these are common sense things, if it's a consumer facing business, do consumers like it, right? Is there a lot of growth on the come, right? Is it hard to compete against? These are common sense questions that a sixth grader, a 12-year-old could answer, right? So Amazon, for example, like, is Amazon's e-commerce business a good business? Well, let's see. In the States, they have 50% share of e-commerce. They have a network of distribution facilities that is, I think they have 1,000. Very hard for any competitor to replicate 1,000 distribution facilities. Every year they do more and more goods, next day or same day service. They have the best selection, the best speeds, and the prices aren't always the lowest, but the prices are generally good. So that's an extremely hard business to compete against. Now, if you and I got together, we'd say, all right, let's see, how many billions of dollars do we need to start a network of 1,000 distribution centers? And then we have to buy millions of SKUs, every day and have them in stock in the warehouse and then get them to customers at a reasonable price.
Yeah.
Like, so I could do what that exercise like we just did with a 12-year-old. So that's the business exercise. Then the management is, as Buffett likes to say, I want a business so good that an idiot could run it, because one day an idiot will. So I've already told you about Coke. Coke's management at one point thought it was a good idea to buy a movie studio. So, are these people running the business, do they know what they have? Do they know that they have a good business? Do they get off the track and do stuff like buy movie studios? Do they self-deal? Do they pay themselves too much money and not care about the shareholders? Are they in it for the long term? Or are they just trying to, cook up short-term stuff so that they can profit in the short run, and then when they retire, they end up handing an empty shell of a company to their successor? So here again, these are common sense questions. But is the management on your side? Are they on the side of you as a long-term oriented shareholder, or are they either stupid or in it for themselves, right? So that's the management question. And then the price question is in many ways the most technical, but, you got to get it for a decent price. You could have the best business in the world run by the best manager in the world, but it still could be overpriced. I mean, in the book, I say, if you go up here to Park Avenue in uptown New York City and you see this penthouse apartment and it's beautiful and the views are stunning and there's, 10,000 square feet, it's huge. You say, wow, how much is it? And they say 5 billion. I'll pass, might be worth $50 million, but it's not worth 5 billion, right? So you have to be disciplined on what you pay, even if you have a wonderful asset. So that's the framework, and it's all very common sense. And as you say, I lay it out in the book, and, I could probably do it with a 12-year-old.
Yeah, it's about you really simplified the process, and
Yes.
the quality remains, but you're just asking common sense questions that just afterwards you're like, I could have come up with this myself, right? But
Well,
I
remember,
didn't.
well, remember, this is, after me hitting my head against the wall, or, wandering around the forest of the stock exchange for 25 years trying to figure all this out. And then, having a period of enforced solitude with COVID, where I could just sort of sit down and put everything down on paper. So it was, 25 years of confusion and then 2 years of putting it down on paper. So, so I'm happy I did, because now life's a lot easier for me, and I'm glad it's a bit easier for you.
So obviously I don't know exactly how you manage or run the fund and who makes the buy and sell decisions. But does
Well,
every company
I do.
you
That's
do?
easy.
Okay. So does every company you buy or sell, well, buy in this case, go through this checklist nowadays?
No, sometimes I just wing it. Of course.
Okay,
What
I
do you
just
think?
practice what you preach. I'm just asking.
Sometimes I just throw something in there because it sounds interesting.
Yeah,
Yeah,
exactly.
I bought a bunch of crypto the other day because
I was
I think
wondering.
I think it's going to go up. Of course, Seam. Of course, I wasn't just writing it down for fun. I do this myself.
Well, it's just I know there's many people out there that say they do certain things, but
Yes,
in practice they don't. So I'm just
well,
asking
that's
for
true.
confirmation here.
That's true. Well, my wife is from North Carolina, a state in the southern United States, and they have one of the best mottos of any government I've ever heard. And it's in Latin. I don't speak Latin, but I know the translation. So it's esse quam videre. And translated into English, you can translate it into Dutch if you like, is to be rather than to seem. So be. Don't appear to be. Be. Be substantive. Don't be window dressing. So, yeah, I try to live by that motto.
That's a good one to remember, definitely. So earnings power, Adam. It's one of the main key words in the book.
Yeah.
What is earnings power?
So earnings power is really a value 3.0 construct, because in value 2.0, in Buffett's world, earnings were earnings, right? Whatever Coke reported their earnings, that was a legitimate proxy for how much they could generate for shareholders in that year, because the business was mature, right? Coke's business was mature, and Buffett made sure that they weren't doing anything stupid with the money. In tech, in value 3.0, it's different, because Amazon will reinvest billions of dollars. They're investing in I think they're investing $10 billion in this Project Kuiper, named after, I think, a Dutch astronomer, to try to rival Elon Musk's Earthlink, Internet for All, satellite-based Earthlink. It's $10 billion, and they might lose it all. So Buffett hates that. He hates those so-called moonshots. But in a value 3.0 world, those are worth taking, those moonshots, because one of those moonshots was Amazon Web Services, was the cloud, which is now worth hundreds of billions, if not $1 trillion. So in the digital age, which we're still at the beginning at, it pays to take these and make these investments, because every now and then you're going to hit a big one. Now, you have to check the management and make sure they have a good track record. You're not just going to say, oh, they're investing a lot of money in moonshots, they must be good. No, you have to have someone like Bezos and Andy Jassy driving the investment decisions. But if that's the case, then what they report as earnings is not necessarily what they could report as earnings, right? So I say in the book that, their e-commerce profitability in the financial statements is like 2% profit margins. And just to compare that, Walmart's is closer to 6 or 8% profit margins. So if you believe the financial statements, then you believe that Walmart's inherent profitability as a business is 3 or 4 times greater than Amazon's e-commerce profitability, right? That's what the financials would have you believe. That's absurd, right? It's absurd that an e-commerce site doing business with, no employees, no retail employees, right? No stores to walk into, right? No depreciation of those stores, no shoplifting, right? All of which Walmart has. It's absurd to think that a digitally run e-commerce site would be a third or a fourth as profitable as a traditional brick and mortar retailer. But that's what the financials have you believe. So in the book, I go through like, well, here's what I think the earnings would look like if they were run as a mature company, right? And that's the earnings power. That's the earnings power. I mean, Amazon, because it has 50% of all the traffic for e-commerce in America, has the third largest advertising business, digital advertising business in the world. It's Google, Facebook, and Amazon. Because they get all the eyeballs on Amazon website, they now sell the ability to be in a prominent position on the website. So I think it's like $90 billion worth of advertising now that they're generating a year. But they report like 20 or $30 billion of profitability in their e-commerce site. But what is the cost associated with the advertising business? It's pure profit. So the numbers are absurd. So you have to recast them to get to what this business could generate if it were run as like a company we're more familiar with, like a Coca-Cola or a Walmart. And it doesn't always have to be just in tech. I'll give you an example of a company in an industry that I won't tell you the name of the company or the industry because I'm still doing work, but very interesting industry, very good industry, industrial manufacturing business. But this one company is a disruptor in the industry and tries to build better products than its competition. And because that, it spends much more as a percentage of their sales on R&D and on their factories. So everyone's margins in the industry are close to 20% operating margins. But these guys spend maybe 5 percentage points more on R&D and on their plant. So their reported earnings is on a 20% margin. But if you really wanted to compare them to their competition, you would adjust their earnings because they're spending more on R&D and plant. So they're inherently more profitable, but they're just choosing to spend more money today because they know or have a high degree of conviction that it will generate more money in the future. And those are the companies you want to look for. You don't want to look for companies that are milking every penny. You want to look for companies that are reinvesting, whose margins are understated, not overstated. And that's what earnings power tries to get at.
That's well said, yeah. Does the company you talk about start with an H?
Uh-huh.
Does it start with an H?
No.
Okay, then I had Heiko in mind, but that's not it.
Well, I would have told you about Heiko because I own Heiko. I talk a lot about Heiko in the book. Heiko is a wonderful company and worth a lot of study, but no, Heiko is public. I don't mind talking about Heiko, Seem. This is a company that I've not spoken about.
All right, fair enough. Yeah, I found the example you made in the book about Campbell's, the soup company, and Intuit. I found that one very fascinating, where
yes,
I'll lay some groundwork for the listeners here. Both companies generate revenue, but very differently, and they spend it differently. In your example, Campbell traded for 20 times earnings, and Intuit traded for, I think it was 43.
Something like that.
Yeah, but after correcting for sales and marketing and R&D, Intuit just optically looked more expensive. But if you played around with some of the margins and the spending, they both traded at around 20 times earnings, which also explains like the exceptional stock price as well. That was just
right. People say, "Oh, it's so expensive. Why does it keep going up?"
Yeah.
Because its earnings power is greater than the reported earnings. And a lot of this Seem is just the accounting is outdated. The accounting was built 100 years ago. Ben Graham helped build our accounting system. That's how old it is. It was built in the 30s. But for example, research and development has no useful life beyond the current year. So every dollar you spend on R&D, you have to expense against your earnings this year. Whereas if you build a factory, you get to write those costs off over 20 years. So in the book, I say, here's a manufacturing company with $100 million of revenue. And here's a tech company with $100 million of revenue. They build a $100 million plant, the manufacturing guys, and they get to expense it over 20 years. So every year they write off $5 million. So if there are no other costs, they have $100 million of revenue, $5 million of, expense on their plant, on their factory, and $95 million of profit. The tech company with $100 million of revenue, same revenue, instead of spending $100 million on a factory, they spend it on R&D. They have to expense every one of those $100 million today. So their GAAP profits are zero. Same companies, $100 million revenue, $100 million. They just invest it differently. But because the accounting rules are not updated for the digital age, one company has a $95 million profit and another company has a zero profit. It's crazy. It's crazy, but that's why value 3.0 is necessary. And by the way, one reason you'll know value 4.0 is necessary is when you see a company that's similarly crazy, like that you can't account for its economics in a value 3.0 framework. You have to go to a new framework. So that's when you'll know. You'll do the same Campbell's Intuit exercise, except it'll be Intuit and another company. When it's that crazy and that disparate, that's when it's time for value 4.0.
Yeah, I was looking at we look at many businesses together, and one of them just surprises us every time. It's Palantir. You probably know it.
Yeah, sure.
I mean, even if you are extremely bullish on the company and give them, or I don't even know, sometimes just these companies cannot be explained even with the value 3.0 framework, where you are just very, very bullish on a company.
No, I know what you mean. Just because I like investing in tech doesn't mean I like investing in every tech company. And there's a lot of BS tech out there. I don't study Palantir. I couldn't help you there. The reason it always sounded like a good company to me, but the reason I never got involved or never got interested in researching it is I don't like companies whose big customer is the government.
Why is that?
Well, it's the opposite of a monopoly, right? It's called a monopoly. If I'm Palantir and you Seam are the government and you're my biggest customer by far, I don't know what percent of their revenues are from the federal government, the U.S. government.
Huge.
So who's got the power, me or you?
Well, probably me.
Correct. So I don't want that. That's not a good business. So I can't help you with that.
I didn't think about it that way.
Yeah, a 12-year-old would understand that, right?
Yeah, but
in
if you
many
flip
ways,
it
you
around,
have to simplify.
I see, but you could also invert it and say, well, the government has unlimited amounts of money and it makes it more safe.
Not really. I don't know if you're following our budget debate over here.
Fair enough.
But no one thinks we have an unlimited amount of money.
Well, I mean, you are the reserve currency, so apparently unlimited.
We can print money, right? But that's different than the government has money. That's the Federal Reserve.
Yeah, you're right.
That doesn't go into the Pentagon's coffers.
So management, the difficulty with management is that there is no real hard data to support what you feel or see a CEO or a management team do, besides its tenure or expertise or whatever. So what do you look for in management besides the obvious, like incentives or founder-led businesses?
There is some quantitative metrics that you can use to determine whether management is, basically you're trying to determine, is management on the side of me as a long-term investor, a shareholder, or are they on their own side, and or are they stupid? That's what you're trying to determine. So the quantitative metrics that I look for are, first of all, do they own a lot of stock? I mean, like, that's a huge one, right?
Skin in the game, yeah.
Like Heiko, the family that, essentially began Heiko owns, 15 or 20% of the stock. And as Larry Mendelson told me for the book, he said, I make $1 million a year. That's my salary. But if the stock goes up, I make $9 million. If the stock goes up $1, I make $9 million. Which do you think I care more about? My salary or the stock price? I make $1 million a year, but if the stock goes up $1, I make $9 million. If the stock goes up $10, he makes $90 million. It dwarfs his salary. So he's not going to be in it for milking the business, for getting his perks, he doesn't care about the salary and all that. He cares about making the stock price go up. So that's number one. Number two is, how generous are they in granting options? And you would not believe, I've never done an academic study, but the correlation just from reading hundreds of proxies is almost 100%, that the more stock a management team owns, the less generous they are with options. Because it's coming out of their pie, right? If I own 20% of a company and I give away 1% of the company, I own 19%, right? I've given away 1% of the pie. My fractional ownership goes down. So you want to see people that own a lot of stock and that don't give away a lot of options. And that's one of the problems with tech companies. Buffett said that giving 1% of the company away is okay. Anything above that is a little suspect. But many of these tech companies give away 4 or 5% of the company a year in stock options. I mean, it's really crazy. So if the company grows 15% a year and you're giving away 5% of the company, you're giving away a third of the growth, right? So these are the quantitative things that you can look for. You want to look for people that have skin in the game, as you say, and you want to look for people who don't give away a lot of stock options. And the second is often correlated with the first. But then, Seem, you're right. I mean, there is a lot of judgment in management. Anyone who talks, for example, about improving margins, that's great for this year and next year and maybe 2 years out. But it undercuts potentially the future of the company because you're not reinvesting, right? Whereas if you hear someone who says, well, our margin is fine, but we'd rather invest money today and depress our margins because we think it's going to be worth more in the future. That's when I really hear I have a long-term focused management team. Like when I started covering consumer products, that was one of my first jobs on Wall Street. I'll never forget Wrigley's company, which is the gum company, right? Wrigley's gum. They were publicly traded. They're not publicly traded anymore, but the Wrigley family owned, I don't know, a third of the stock. And they would come to investors and they would say things like, we're spending $300 million next year to break Chiclet's monopoly in Mexico. They wouldn't apologize or anything like that because they knew that $300 million had probably a return associated with it, but it was going to tank earnings the next year. But they didn't care because they weren't about optics. They wanted to be rather than to seem, right? A lot of Wall Street does not follow the motto of North Carolina, right? They seem rather than to be. So I'll never forget, that was Wrigley's. And then I would talk to the Heinz company, which owns the ketchup, right? The ketchup and so forth. They would always be talking about margins and cutting this to get a higher profit margin and cutting that to get a higher profit margin. And they would cut their advertising budget, for example. Like, that's undermining your long-term brand equity. So I would hear Wrigley talk one way, and then I would hear Heinz talk another way, and then I would see that the stock market would figure it out because Wrigley's would trade at 30 times earnings, and Heinz would trade at 12 times earnings. See, the market understood that $1 of Wrigley's earnings was much more valuable than $1 of Heinz's earnings because Wrigley's was investing for the long term, and Heinz was undercutting systematically their terminal value. So you want to listen for people who are over-investing in their business for the long term and not milking the business. American capitalism is great. It's the best system, ever invented. I heard the other day that our stock market last year appreciated more than the entire market capitalization of the German stock market.
I heard that too.
It's an incredible statistic. But we do have problems. We're not perfect. So I'm proud of our system, but we're not perfect. And the biggest problem is our short-termism. We are short-term. So great industrial American companies like General Electric fell victim to just what I'm talking about, pumping up profits, pumping up margins, but underinvesting in the business. And, the chickens came home to roost, and GE has had a lot of problems, which is only now just recovering from. And then, poor Boeing, which is, the dominant aircraft manufacturer, also bump up earnings, cut, 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 cut. There's a great book by a former Bloomberg reporter just detailing how systematically the financial engineers took over from the aerospace engineers. And it looked good for a while. The profits were good, the stock price was good, and then the bottom fell out because it's not sustainable. You're not investing in a sustainable business. So I own Airbus. That's one of the few European stocks I own because I knew that they were investing for the long term. They're run by aerospace engineers, not financial engineers.
There's a great documentary you might like. It's about the Boeing scandal.
Yeah, there's a whole bunch of them. Yeah,
It's
I
on
read.
Netflix, I believe.
Yeah, I've heard about that. I read the book called Flying Blind, and
Might be similar.
it's yeah, it's not pretty. So you want to look out for that kind of behavior.
Yeah, absolutely. Yeah. Do you think that, I mean, we're becoming even more tech savvy today than 10 years ago, and it's only going to increase from here, I suppose. Do you believe that there are still like old economic moats that will perhaps be even stronger because the
Sure,
technology advances so fast? Maybe do
sure.
you have a couple of non-tech
I mean,
company examples?
half of my investments are in tech, but the other half are not in tech. So Heiko, for example, is a wonderful example. I mean, it's the only manufacturer at scale of generic replacement parts for airplanes. So General Electric, Honeywell, General Dynamics, United Technologies, they all sell their original parts to the airlines for exorbitant fees because they think, oh, the airlines have no choice because we're the only game in town for our part, or there's maybe two suppliers, and they informally collude to keep prices high. So 30 years ago, here comes Heiko along saying, that's interesting. We can make parts that are similar quality as the original manufacturers, but we can sell them for 30, 40, sometimes 50 or 60% less than the original guys, and we can still make a good return. So they've been doing that for 30 years, and they've never had one defective part, even though they're generic. Never had one defective part. The FAA loves them. They sell to all the major 20 airlines. So this is an old-fashioned moat, right? This is just a company that came up with a better way of doing things and cheaper, same quality, taking advantage of a price umbrella and abusing pricing power from the part of the GEs of the world. And they only have like 3-4% market share. So yeah, there's a lot of old-fashioned moated businesses like that. A lot. And I own a lot of them. Progressive Insurance I own.
Adam, I can keep talking to you for another hour. I don't know how busy you are, but I have a couple more questions, and let's wrap it up then.
Sure.
Yeah. Okay.
Yeah.
Well, what I was wondering was, you've got lots of experience in the market now. Looking back, what were a couple of your biggest mistakes or lessons you've learned so far that anyone starting out today or investors listening to this can learn from?
Well, I've made about every mistake in the book, so it's our business is very forgiving because I literally have made just about every mistake you can make, and I'm still surviving. So, my biggest mistake probably is just not paying enough attention to the quality of the business, being too focused on the numbers and not on the business. Because the numbers are published here, we tend to think that they're real, right? They're in black and white. They must be real. Truth is that the quality of the business and the quality of the people that are running the business, that's what generates these numbers, right? Jeff Bezos and Andy Jassy and all those people generate these numbers. But we think backwards. We think that the numbers sort of, do you see what I'm saying? The business and the people drive the numbers. The numbers are a consequence of the business and the people. I was too focused on the numbers and too interested in paying a cheap price and not interested enough in finding a high quality business. Once I figured that out and inverted, that's why I say business management price, right? Price is last. Too many people start with price first. I want to find a cheap stock. I'll give you a cheap stock, but it probably crappy business. It should sell. It's like merchandise, right? It's like, why would you go into a grocery store looking for cheap bananas? Sure, look for cheap bananas, but they have to be good bananas too, right? So it's much better to look for a good banana and then look at the price rather than find a cheap banana and say, oh my God, I can't eat this banana.
Unless you're making banana bread, right? But
Correct.
Yeah, I get what you're saying.
See, that's a very good caveat. I agree with you. Then you got it made because you can buy all the brown bananas you want.
No, but I hear what you're saying. Yeah.
But that's been my biggest mistake.
So your best piece of advice would be that focus on the quality and let the price come last?
Yeah. I mean, that's a little too simplistic, but my biggest mistake has been paying too much attention to the price and not enough attention to the quality. I don't want to over exaggerate that because you have to pay attention to the price. If you find a great banana, but someone wants to charge you 100 euros for a bunch of bananas, good luck. You're not going to do well. So I don't want to oversimplify it. You have to pay a reasonable price, but don't let price be the tyrant.
Yeah. Well said, I guess. What's your favorite chapter of the book?
I thought you were going to ask what's my favorite banana bread.
No, not really. I don't know any brands.
Do they eat banana bread? They eat banana bread in Holland?
I mean, someone does.
I guess so, yeah. What's my favorite chapter of the book? I don't know.
You can say you have no favorite.
I mean, I like history. I enjoyed writing the history, especially since the publisher said, no one's going to like that. And people like that a lot. People like that section of the book, the early chapters of Ben Graham.
Yeah, I liked it too. Yeah.
Yeah, because it gives context, and I enjoyed those. I liked them all, but those were fun to write, and I found that I get a lot of positive feedback from those chapters.
So, since we're both shareholders of Amazon, before we end this episode, please tell the listeners why they should get the book on Amazon. Of course, just kidding. Why should people get the book? What are they going to get out of it? If you had to say so.
Well, I mean, you should get the book if you want to, make sense of two things, I guess. One is, how to be an investor generally. A lot of young people starting out, they understand tech, but they don't really understand the market. They don't understand why Apple has gone up, 15 times over the last 10 years or whatever it is. The book tries to explain why a stock price grows. A stock price grows because the business grows. The stock price just follows the business. It's not magic. It's not a mystery. It's just the stock market is a place for weighing and assessing value. So if you're interested in how the stock market works and how companies grow and create value, I would get it. And then generally speaking, and then specifically, if you're interested in how tech companies create value, I think it's, it has a lot of interesting, fresh, innovative ideas. There's a lot of classical books. Ben Graham has written couple classic books on value investing. but none that I'm aware of tackle value investing in a discipline. I mean, tackle technology in a disciplined way. That's what I was trying to do. I was trying to take the discipline of value investing, 100 years old, from Ben Graham, great framework, but I was trying to marry it with the new realities of our digital age.
It reads very, very nice. Some of the older books are very tough to get to, and I'm a very passionate investor, and I love reading every book there is. But some books are tough to get through.
Yes.
But this one, I'm not exaggerating here, but I think I've read it in like 2 or 3 days. It just the writing style is very, very easy to understand. It's like a story you go through from the beginning to the ending. Well, at the end, you're like, it's an open end. You got to stay curious. There will be a value 4.0, and I really like the book. So well done.
Well, I appreciate it very much. I worked hard at making it readable, and it helped that I was a journalist. Journalists at their best specialize in making complex issues digestible. So that was my goal, and I'm glad with at least one reader it landed.
At least one.
At
Well,
least one.
I'm looking forward to the next book, Adam.
Yeah, I'm starting to think about it.
Yeah, definitely. We'll get you back on once it's done. Whether that's 5 or 50 years from now, we'll see.
No, it won't be 5. It certainly won't be 50. Maybe 3.
The truth is always somewhere in the middle.
Right.
Well, thank you so much for coming on the show, Adam. Your book has really helped me rethink how I was investing, and many others as well. So I really appreciate it. Before we go, where can people find you? Where can people get the book other than Amazon?
Well, just Google, where the money is, and you'll find it. Amazon obviously is a good place. Your local bookseller probably has it. I walk into bookstores and they have copies, or you can order one at your local bookstore if you want to support your local bookstore. What was the other question, Seem?
Are you active on LinkedIn or X or somewhere?
I don't do social media. As I told you, I'm not wild about technology itself. I do LinkedIn, so people can feel free to message me on LinkedIn. I'll reply.
All right. Well, that's where you can find Adam. It's, by the way, LinkedIn, very profitable tech business. So definitely read the
Yes.
book and you'll understand why LinkedIn was such a great.
Bought by Microsoft for, if I recall, $25 billion, and
Exceptional.
it's probably worth 4 or 5 times that now.
Yeah. Well, once again, to everyone listening, get the book, Where the Money Is, Value Investing in a Digital Age. Thank you so much, Adam, and I hope to talk to you again someday.
Hartelijk dank. That's all I got.
Well, goodbye means goedendag.
Goedendag.
Goodbye.